All right, folks. Well, welcome to today's session. First one that we've had here in the last couple of weeks, or 6 weeks or so. Uh, February was one that we held off doing, given it was RSP season for us, and also with getting some feedback from everybody about the cadence of the sessions. I'll chat about that a little bit later. Today, I'm going to speak for roughly half an hour, maybe a little bit longer. I do have information on the slides, but I'll probably spend more time maybe chatting about what's been going on in the markets and the economy globally. Kind of top of mind for a lot of folks, more so than what it was obviously just a couple of weeks ago. Just as a quick reminder, if you have questions, you can enter them in the Q&A or the question and answer section. I will try to answer them kind of throughout, or I'll spend some time at the end. If for whatever reason I can't get to all the questions, I will do my best to send an email thereafter. Okay. So we're going to jump into it. This has been an evolving presentation over the last number of days. Things have obviously changed somewhat significantly. So I thought what I would spend the majority of my time on is point number one, which is the economic and market update, which is tied into the second one, which is global uncertainty and how does that impact us as investors. And then also just talking about how do we protect ourselves from it. So I guess they are all somewhat intertwined, one and the same. But again, I'm going to spend most of the time on just, what's happening globally and how it affects us today. So with that, I'll just jump into it. I always start with one of these, and I saw this came across my desk. I thought it was somewhat timely given everything that's going on in the world today. So let's just talk about the economic. It's really interesting. We're kind of in two phases of the economy or the markets right now. And what I mean by that, I was chatting about this morning, fundamentally, what do the markets look like? And then number two, what's happening to the markets and the economy, given what's, given it's event driven, what's going on in the Middle East right now. So up to the beginning of the conflict, pre-conflict this year to date, markets were actually doing fairly well. Canada was leading the charge. It was the strongest performing North American market. The other markets were a little bit more sluggish, but we're still positive mostly on the year, with the exception of the Nasdaq, which was struggling to find its footing, given the fact that we were getting decent earnings from some of the tech companies. But, as Dominic mentions, the tech and growth companies, they're priced to perfection. Any little headwind that came out, or even if these companies came out and they met all of their expectations, what we're seeing is they've hit some headwinds. So it goes back, and I'll talk about this, about the importance of diversification, not being overly concentrated in some of these names. So again, pre-conflict, we were in pretty good shape. So why is that? Why was the economy doing well despite some of the headwinds of the tech and even some of the global conflicts that we were seeing before the actual late February, what's happened in Iran? So when we look at earnings, the outlooks remain strong. You look at banks, retail, software, semiconductors, and so on. This is a chart here that goes back over the last 5 years, and it just shows the forward earnings, the forward profits of these companies looking forward. And as we can see, since late October of 2023, which is when the bull market, the current bull market, which by definition is an increase of 20% or greater from the bottom, since that period of time, you can see earnings has significantly picked up. And we've seen this in Q3, we've seen this in Q4. The earnings that are coming out from these companies that are reporting have been significant. Q4 is just coming out, but again, Q3, Q2, they met or exceeded historical expectations significantly. Positive earnings tends to come in somewhere around 60 odd percent, 60, 65%. Q2 was over 70%. Q3 was over 80%. So again, we anticipate earnings to continue to be robust. Hence the reason these companies continue to go up in value. So when we look at the what's driving returns this year, and this is kind of pre-global conflict, when we actually look at it again, earnings are driving a large portion of it. Slightly, somewhat in the dividends are also driving it. But when we look at emerging markets and Canada, really actually across the board, even when we look globally, it is the earnings and PE ratios that in large part are driving the earnings in general. So that's number one. So why fundamentally, from an economic point of view, are we in good shape? Number one, again, we feel there will be continued good, strong earnings. Number two, coming into this year, when we looked at the interest rate outlook, we anticipated, at least in the US Fed to continue to cut rates into this year. Now, notwithstanding, again, the conflict that's just started roughly 2 weeks ago, we anticipated the rate cuts out of the US to likely slow, just given some of the economic data. But that being said, we still felt that there were going to be a couple more rate decreases this year. In Canada, we felt the Bank of Canada was already near where they wanted to be, their range. We thought maybe there might be one more this year, but we're not so sure on that one currently. The biggest one right now is in the US, and I'll talk about what our thoughts are on a go-forward basis. So one, corporate earnings. Two, monetary easing. Again, good for the economy. When we look at some of the manufacturing information, and on this slide here, what's interesting, I talked about this in December when I said, hey, what should we look forward to in 2026? Do we actually think there's going to be some momentum? What's our outlook? What I said in the December session, I said, hey, when you look at from a manufacturing point of view, where it currently is versus where it's projected to be, which is this red dotted line, we actually felt it was undervalued and it would actually pick up towards the forecast. Well, if we fast forward to today, the most recent data, this is exactly what's happened. So we've seen this sharp increase in the actual numbers, and it's now trending closer to what we thought the projection was going to be 3 months ago. So manufacturing is picking up in terms of the data, which is another positive sign from an economic point of view. And then one of the last pieces I'll talk about here is tariffs, trades and tariffs. And I talked about this in the last session. In Canada and even Mexico, our tariffs aren't as significant, even though they feel like they're high, just given the actual treaty and the agreement we have between Mexico, Canada, and the US. And they are below 5% when you average them all out. Now, given the fact that the Supreme Court came out and they had a ruling on it, we can actually see tariffs are actually declining or actually moving downwards. So we believe from a tariff point of view, they likely have peaked, which is only going to be good for the bottom line, good for consumers in terms of how those tariffs and trade policies end up being filtered down into our goods and services that we're buying. Now, one of the things that we recognize is a headwind. So I just mentioned the 2 to 3 good things that we think from an economic point of view, why we think things are going to be good. Well, one of the things that's deteriorating is the labor market. So the most recent data that just came out recently, it was a significant miss. The economists, the analysts felt that there would be actually job growth in the most recent data. There was a significant decline or job losses of 92,000. So the swing was well over 100,000 versus expectation in reality. So the reason we're bringing this up is we recognize a deteriorating labor market is not ideal for the economy. And this generally gives the US Fed an opportunity to potentially cut again to help mitigate some of this decline. Now, this is the pivot in kind of this session today is what's going on in the Middle East and how does it affect us as investors? Okay. And I'm going to boil it down to one of the key things, which is obviously what's happening with oil in general. It's definitely a significant issue, guys. I mean, obviously, if we own Canadian companies, which we do, they are benefiting from the rise in oil. We've actually seen a fairly significant uptick in some of these Canadian names, which means for those of you that are on this call that also owns Canada, this is a benefit for the portfolio. Where this actually is a deterrent is things are getting more costly. Obviously, at the pump, I'll show a slide in a second. It's going to take time for that to get priced in. Oil went as high as $120. In the last couple of days, it's been very volatile, as low as $80. It fell, I think, 12% yesterday. Fell significantly the day before. So we're seeing a lot of uncertainty surrounding the price of oil. And obviously with oil, it just affects so many things in the long run. So with this slide here on the left, this just shows the Strait of Hormuz of the amount of traffic that flows through here, okay? Oil and gas tankers, other tankers, container ships, and so on. It is a significant path that a lot of these tankers take. Not very wide, roughly 21 miles in width, so it's not overly large. But you fast forward to today, we can see how few ships are actually passing. And obviously today we're seeing some of these are now getting attacked. They're putting, these mines out in the strait. And the challenge, obviously, is it just grinds the transport of oil to a halt. And not just oil, but other goods and that we need on a regular basis, fertilizer and so on. But the longer this goes on, the longer that container ships, oil tankers, and so on can't pass through here, it could spell obviously some economic challenges if this conflict is prolonged. So when we actually look at the price of oil, I think this is what's critical, is we can recognize that there's been peaks and valleys throughout history. This isn't unusual. It's not unique, but it is current. So when we actually go back and look at, Russia-Ukrainian war, we can see here, Ukraine war, we go back to the global financial crisis, we can see periods of time where we had significant increases in the price of oil. I don't think anything has moved as quickly as it has in the last week or so. So that's a little bit of a challenge. But again, we've dealt with high periods of the price of oil, as recently as, a number of times in the last, 17, 18 years. So if we look at where we are today, and it was difficult, like I said, this presentation has been changed a number of times. It was really hard to actually find a chart that was relevant. And this is this chart I actually had in, I took it out, put a more up-to-date one in, and then I went back because I thought, given the fact that oil is trading in and around $80 to $90 again, this is a good illustration of the importance of the price of oil. So when we look at it, from a cost perspective, between roughly $60 and $70 is give or take the price that's needed to be for a new well to be profitable. So if we're elevated above that, obviously these companies, they're going to be potentially at a loss of drilling if we have prolonged periods of high oil prices. Again, if you fast forward this over the last couple of days, this was as high as up here and has come back down. So we actually haven't seen oil at this price at certain periods since the Russia-Ukraine conflict. So again, any narrative that comes out from the U.S. Or their allies or partners, where they think this conflict is going to be shorter than expected, we're actually seeing a significant change in the price of oil and also the markets. And that's where I think it's important to go back to what I was saying before, is the importance of fundamentals driving the market versus events driving the market. Okay. And this leads me into this piece here, with the price of oil being higher. And again, this just goes back since 2021, is at what point do we start seeing it impact the price of gas? Well, in the U.S., I can tell you, I was in the U.S. on the weekend. I was kind of on somewhat of a road trip, driving things back with a buddy of mine. We had to bring some personal items home from a property that sold. And I can tell you, gas was really expensive over the weekend when oil was over $100. And it changed on a daily basis, if not even on an hourly basis. So we actually haven't seen it actually get all the way down into the cost of gasoline on a long-term basis, but it is happening on a daily basis. So we anticipate the cost to go up. And why this is problematic is, from an inflation point of view, these numbers are actually going to get into these inflation numbers over time. And this is where it's going to put the U.S. Fed in some challenging situation where they can say, hey, should I increase it or decrease interest rates? And we actually think what's going to happen, given the state of the price of oil and some of these other things, we actually think the U.S. Fed is going to continue to push out rate cuts even longer now to see how the increase in these goods are going to have on those inflationary numbers. So generally speaking, like I said, monetary policy, I mentioned in the very beginning, we felt there was going to be 1 to 2 rate cuts. We still think that it's just going to perhaps be a little bit slower. Okay. And so when we look at market post-conflict, and I'm going to come back to my comment earlier about fundamental versus event-driven, because I started down that path. I didn't finish my comment or my thoughts, but this is what's happened post-conflict, okay? And it's a really good kind of segue into what I just mentioned about these kind of divergent paths on where we think the markets are going. So when the news was negative and lots of uncertainty, we saw declines in the market, which was March 6th, which was last Friday. And as we got into Monday, Tuesday, again, the narrative on the conflict, on the time frame was going to be shorter than what was anticipated. The end was closer than further, is what the narrative was. And as a result of that, oil fell significantly, which I mentioned earlier, and markets digested it and actually had a pretty good day on Monday. And yesterday they were somewhat flat after a choppy week last week. And so this is a good reminder that we can look at and say, hey, what's driving the market today? Is it fundamentals? Okay, I talked about earnings, monetary policy, and so on, or is it event-driven? Currently, today, it's event-driven. So depending on what transpires with this conflict, if things can be resolved or they can figure it out, then what we'll likely see is markets revert back to the fundamentals. And we still think that we could have a decent year ahead of us if things kind of get a little more tame in the Middle East. That being said, we don't think there is an end in the near term, but again, we don't know how long or how prolonged this is going to be. So what's important is we go back and reflect what's happened historically. So when we go back to these different global events, whether it's the Ukraine invasion, Iraq, Liberation Day, Gulf War, when we have these conflicts at different periods of time, there's always a lead up to the actual event that happens. And I've noted that by this red line here. So we generally see markets get a little choppy as the uncertainty starts to pick up with some of these potential global conflicts, okay? When the event actually happens, so again, this is 6 months out, 5 months, 4 months, 3 months. Well, when the event actually happens, here's what happens afterwards. 1, 2, 3, 4, 5 months out. And what we can see on average, in some situations, it goes down, okay? But in general, things actually stabilize, and on average, things tend to go up a little bit. So if we go back to US-Ukraine, or Russia-Ukraine conflict, which happened in 2022, again, lots of uncertainty. And one of the things I wrote about was here's generally what happens when we go through these periods of global conflict. And I remember writing this commentary, and there was a chart. Well, what's happened since that period of time is the S&P 500 and markets have actually posted some of their best years in history. The S&P 500 did something it hadn't done in decades, which was to post back-to-back years of gains over 20%. Part of that is because it was coming out of the most recent bear market, which was a decline of 20% or greater. So again, it just gives you an idea that even though that situation at the time was very unnerving, what's going to happen on a go-forward basis, markets went back to their fundamentals, went back to corporate earnings, went back to monetary policy, and digested the news, and things move forward because companies maintain their profitability and they continue to sell, to consumers like you and I. And so again, even though there was a global conflict, things reverted back to the means. And that's generally what we tell people, is that the catalyst can sometimes be different, but the result can, if you go back, can be very predictable. So how are we treating this? What's the important way for us to look at it? I haven't changed my thought on this for the last number of quarters, but diversification is what's key. And we've been talking about diversification largely because of what's been happening with these growth companies, what's been happening with the top 8 to 10 companies, the Mag 7s that have been driving the markets in large part over the last number of years. And what we've said is, hey, the right way to manage this risk in AI, in technology and growth, is to diversify the approach. Don't own 100% or a high percentage of these companies, but rather pieces of these companies in collaboration with other asset classes or other global markets like Canada and foreign and international markets. So here's a good example here And I'll go back to actually a chart in 1 second, but here's like an example where technology that has been leading the charge over the last number of years have actually been some of the worst performing sectors in the markets, both on the Canadian on the left side and the US on the right side. Okay. Now, it's not a surprise. Those have done really well. So we would expect them to have a little bit of headwinds at some point. But if you actually go back to some of the other stronger sectors, things like energy, utilities, consumer staples, financials, at least on the Canadian side, these are actually things that have been really strong in general. Okay. And if we go back, sorry guys, I'm going to flip backwards here, but if we go back to even what's happened with the markets post-conflict, what's really interesting is the NASDAQ has actually been the best performing market over the last 2 weeks. And that's large in part because these were some of the ones that were most sluggish or most challenging for the first 6 to 8 weeks of the year. Okay. So number one, diversification. There's a rotation in the market we're recognizing. Okay. These are just, this is a slide here that just shows the Mag 7 versus the S&P 500. So companies like Apple, Alphabet, NVIDIA, Meta, Amazon, Tesla, and so on. These are what they performed year to date. Okay. Again, Microsoft, as an example, has been the weakest, but they had really good earnings earlier this year. They actually exceeded, met or exceeded on most of their forecasts. But despite that, because they gave some guidance in the future, what's happened is their share price has actually pulled back. Yeah, I still like, full disclosure, I own Microsoft. I have not sold it because I believe over the long run, it will still do well because we're going through an innovative wave, within the overall economic landscape, and that, we're going to continue to use technology or these companies. It's going to shape the way we live in the future. And Microsoft is a big player in that. Plus, they have different divisions of businesses, so on and so forth. So I'm not suggesting everybody runs out and buys it individually. Most people on this call will own every one of these investments in some form or another. But again, things are cyclical. So when these were doing really well, maybe we had other things in the portfolio that were not doing quite as well, and vice versa. Okay. So it's important that we actually take a more diversified approach to smooth out these volatile times in some of these sectors. Okay. And so one of the things that we've done, again, just to go back is, for a lot of you, we have 5 asset classes versus 2. So when I say 2 asset classes, for most Canadians, it's stocks and bonds. That's it, unfortunately. Okay. Bonds in general, I'll show a chart in 1 sec. The 5-year return, total return on a fixed income product has been roughly 3% on the Canadian index. So an ETF that tracks the index. 3%, not annually, 3% total in 5 years. Okay. So for most Canadians that have, subscribed to, that traditional balanced investment where it's like 60 to 70% stocks, 30 to 40% in fixed income, unfortunately, 30 to 40% of their portfolio has struggled significantly in the last, 5 years or so. So what we've done for a lot of our clients is we do subscribe to stocks and bonds as well, whether it's through individual stocks, ETFs, managed investments, or so on. But we have also added asset classes similar to pension plans. So we've added infrastructure, we've added credit, we've added real estate. And what this chart here shows is as you add these types of asset classes, in addition to public equity, in addition to high yield bonds, investment grade bonds, and so on, what happens is we actually move the risk. So here's the risk, here's the return. By adding these, we actually move the risk down and we improve on the upside. So we smooth out the volatility in portfolios, okay, which is what we want, especially in periods like this when there's uncertainty. We want to have something that's more predictable. And instead of being up 10, down 10, up 20, down to whatever, we'd rather be, much more consistent and less volatile on the up and down. And so by having 5 asset classes, this is exactly what's happened for pretty much everybody over the last number of years. Okay. So when we actually look at public versus private, just to give you an idea. So public credit, again, here's a Canadian ETF in the universe, Canadian universe bond. It's an index that tracks it. Over the last 5 years on a total return basis, this investment would have yielded 3%. That's it. So if you invested $100,000, you'd have $103,000 after 5 years. And this is, again, what most Canadians have been investing with a good portion of their portfolio. Okay. On the private credit side, and I'm just using our rockers, but there's other ones that you can look at as well. But again, private credit is, you look here, very consistent. This gets valued on a monthly basis, which is the reason why you don't see volatility like this, but rather very consistent. Over that same 5-year period, this private credit has actually returned 32%, 32.5%. So that same $100,000 of investment has actually grown to 132,000 versus 103,000. So this is average roughly six and a bit percent. This is average roughly 0.6%. Okay. So it's not ever suggesting everybody runs out and invests just in private credit, but it's important to have some private credit in the portfolio as a diversification. Okay. Public REITs. So public REITs, RioCan is a company here in Canada. I don't know if you guys are familiar. Again, RioCan is the name. For those of you that are familiar in Langley, right on the bypass, there's a golf town, a Cactus Club. There's an Indigo on the other side of the street. Those properties are owned by RioCan. Again, a Canadian publicly traded REIT. All right. Now, if we own those, and if I own them, we would have invested them, again, it goes back 5 years ago, lots of volatility. So this is just the Canadian REIT index. This is the US, or sorry, other way around. Purple is Canadian. The orange kind of color is US. So in Canada, if you own a Canadian REIT index, which tracks the number of REITs over a 5-year period, you would have returned roughly 17%. That's what the return would have been. And if you go back to a year and a half, 2 years before this, when we went through COVID, REITs, publicly traded REITs, were down 50% in a matter of days. Okay. I know, and I use that example of RioCan in 2020. I know the companies that are basically paying rent and leases in those properties, they continue to pay. They continue to pay. They're fully rented. Some of those companies in there are having banner years, and yet these companies that own that property have significant volatility despite good quality underlying businesses. Okay. So this is public REITs. Again, most Canadian investors, this is how they add real estate to a portfolio. Lots of volatility. Okay. So for a lot of you that are on this call, there's private REITs. So private REITs over the same 5 years, yes, things have softened a little bit, but again, over the last 5 years, has generated a 42% rate of return, or just over 8% in those 5 years. Okay, 8.4% or so. So again, we talk about diversification, not only just in asset classes, we also talk about diversification in terms of geographical. So we're not overweight or concentrated in the US, despite the big Mag 7 companies driving the markets. We own portions of the portfolio in the US, but we also own Canadian, and we've been adding more to Canada in dividend producing investments and so on. So the benefit is that Canada, surprisingly, the last couple of years has been the strongest performing North American market that we've seen, which is highly unusual. That doesn't generally happen. Usually they lag the S&P 500, the NASDAQ, and so on. Last couple of years has been the best. Part of that is because of the exposure to some of the commodities and materials. But again, this is the reason we don't put all of our eggs in one basket. Okay. So again, how do we deal with this conflict that's happening in the Middle East? Again, the best way to do it is to actually take a pragmatic approach, accept or understand what the risk is, and manage that, which is what we've done in 2020. We did that in 2022. Last year during Liberation Week, when tariffs and trade policies caused some significant volatility and even decline in the markets of almost 20% in the US, for a lot of you had a very good experience where we were down at mid to low single digits, again, by taking that approach. So that's not going to change for us. We're going to continue to manage and stay on top of what's going on in the world. We obviously recognize it's a quick moving story. Things can change on a dime, but based on how we're positioned today, we think we're well prepared for it. So with that, like I said, I've given you my opinion from a fundamental point of view in the markets, kind of what's going well. I've talked a little bit about what's not going so good from an economic, which is the U.S. labor market. And then I've talked about some of these challenges that we see specifically around oil and how that price of oil is going to filter its way down, from a general economic point of view, and then talk a little bit about how do we manage that risk. Okay. So with that, I'm going to wrap there. I could have talked for a lot longer, but I wanted to make sure this was digestible. I wanted to make sure that people understand that we're on top of what's going on. We're actively, watching the news. We're watching what's going on. We're reading reports. I personally have money invested in the market as well. So what's going on today impacts me and my family. So it's important for me to make sure I'm managing our wealth along with yours as well. So with that, I'm going to just, if there's any questions, I do have a couple up here. I will talk about it here. I'm going to wrap here. Actually, before I wrap, I do want to circle back, and I'm going to answer questions. I also want to talk to you guys a little bit about some of the feedback we received from everybody. We sent an email out probably about 4 weeks ago to say, hey, we'd like to get your feedback on the cadence of our info. I'll give you a little bit of that info as well. So first question I had is about time in the market. So I had somebody here that just said, hey, we're getting a little bit panicky or a little emotional about the markets. Do we think we should be rotating out and sitting in cash? Which is a question that, we get more frequently in periods of time like this. So what I generally say to people, I say, listen, like, it's your money. We'll do what you want, but we would be doing a disservice if we didn't provide our comments. Okay. Making a substantial change of selling out of the market and going into cash is difficult. And the reason why it's difficult, number one, you might have some tax implications. You're going to trigger unrealized capital gains, which could be significant for folks on this call. But the second one is it's easy to actually make significant changes to get out of the market. The biggest issue isn't getting out of it, but it's when do you go back in? And so what we saw, and I'll use a very recent example, back in early last year, again, I talked about Liberation Day and these tariffs and trade policies. Markets reacted quite quickly. They fell quite quickly over a very short period of time. I mentioned that U.S. markets fell anywhere between 15 to 20%. And so people were asking me, they were saying, hey, I'm nervous. I don't like the rhetoric that's coming out of the U.S. Should we get rid of U.S. investments? And what we said at the time, we said, listen, no different than now. We prepared for this volatility, this uncertainty, and how we've designed the portfolio from the get-go. We don't believe that we should be selling and being out of the market at this point because it's really difficult to predict. Okay. So that's what our counsel was. And for the most part, everybody stayed invested with the exception of one or two people. Now, what transpired very shortly thereafter was that the administration of the U.S. came out and deferred tariffs by 90 days. They made the announcement in the morning, and within minutes, the markets rallied. And some of the markets had historical days. So the NASDAQ, as an example, was up more than double digits in one day. It was incredible. Okay. So for individuals that let their emotion kind of drive their investment decisions, that moved out of the markets to be into something more conservative or in cash, they missed that upside. Because what happened shortly thereafter that announcement occurred, individuals that were made a move, they all said, now I got to get back in because I don't want to miss out. Well, that 10% move in that one day on the NASDAQ and double digits on some of the other ones or high single, those investors never made that back up again. Okay. So it made more sense to invest the portfolio based on time frame, risk tolerance, comfort, and so on, and actually weather some of these storms. Okay. That is what we're suggesting today as well. At this point in time, we do the same. Okay. Your portfolios are invested based on your time horizon, based on your risk tolerance. If things have changed, by all means, we can shift the portfolio, but our suggestion isn't to time the market. It doesn't work for Warren Buffett. It doesn't work for the majority of our clients as well. Okay. Okay, so I have another good question. What is my take on investing in anything in the US? Yeah, my view hasn't changed. I wrote about it a number of months ago. I said, hey, does the US still make sense? Absolutely. No question. The US is the largest economy, the largest market, the most broad market in the world. Okay. There are companies down there. Fundamentally, if you say, I don't want to invest in the US, I don't want to own it for different reasons, no problem. But from a fundamental and an investment point of view, I don't see why we wouldn't. And I'll use one example that I own in my portfolio, which is Coca-Cola. Coca-Cola is a U.S. investment. It's domiciled. It was founded in the U.S., but it's an international and global a company. They're all over the world. If you drank one of their products every day until you went through their shelf, it would take you over 3 years to drink every single product that they own. Okay. And that doesn't include other or silos of businesses. So I do believe you do need to own the US. You need to own some of these tech companies that are reshaping our world. Okay. AI is not going anywhere. Technology and growth and robotics, that is accelerated growth that's going to continue to happen regardless if we want it to happen or not. So these companies, if we don't own them, you're simply going to miss out. So then you say, well, what are my other options if I don't want to be in the US? Well, there's Canada. And Canada has its own problems. Canada is a very narrow market. There's 3 major sectors in Canada. There's resources, commodities, and financials. And even when you use financials as an example, financials, there's only 6 big banks, 6 big financial institutions, 3 to 4 big insurance companies. So the problem with investing just solely in Canada, which Canada actually has one of the highest home bias investment percentages in the world. What that means is you buy what you know, but the problem is Canada is just so narrow. Even from a GDP point of view, from a global perspective, it's in the single digits. So we barely make a mark on from a global GDP perspective. So investing all of our money in Canada is problematic as well. And so then you go, okay, well, what if I go to international? Absolutely. Europe's great. There's a lot of good companies outside of North America. But again, you open yourself up to, not so much in developed Europe, but if you start getting into Asia and so on, there are good businesses there, but then, their accounting principles might not be as tight as what it is here in North America. And you're taking on risk for those types of companies. So is there that much more return in those companies than here in North America? So again, I do believe you continue to still own US companies from a fundamental point of view. So, okay, somebody else has a question. Let me just read it. Let me see. Yeah, so basically, somebody just said, if you feel we're on top of things and we're positioned appropriately with current market conditions, can we assume we are not likely to see many changes in the portfolio? Yes and no. We subscribe to a number of different securities. So we subscribe to individual stocks, ETFs, but we also subscribe to having some managed money in there too. And so even if the positions don't rotate in terms of the names, there is rotation happening within the portfolio that you may or may not see. So the fact that we're not buying and selling or increasing, bonds or cash or whatever, doesn't mean the portfolios are staying stagnant. Okay. So as an example, some of those sub-advisors, are either being replaced, they're being removed, ones are being added to, they're also adding to different sectors and regions as well. So we're happy with the process of how things are evolving in the portfolio. And then the last piece of this individual said, hey, we're aware each person's portfolio may have different decisions to be made. Absolutely, guys. So that's a key point. I think that's actually a very observant and good comment, is that no two of you on this call are going to have the exact same feeling about how you think global conflicts will unfold, or what your specific cash needs are, or what your future goals are, whatever it is. Everybody is unique. So that's why we have these conversations with folks and we say, hey, tell us about your story, tell us what's changed so we can actually make adjustments as needed. But for those of you that have a mid to long-term time frame, when I say long-term, guys, some folks on this call may say, I'm getting older in life. I don't have the long-term. I say long-term in terms of a market cycle, okay, which is anywhere between 7 to 10 years. And what I say in a market cycle is we have bull markets, which are 5 to 7 years, and we have bear markets, which are, 18 months to kind of 24 months, give or take. That gets us to the 7 to 10 years. So what I look at is we're 3 years, 2.5 years into the current bull market. Okay. So again, a bull market by definition is an increase of 20% off the bottom, an increase of 20%, and then everything else thereafter is considered a bull market until we get a correction of 20%. Okay. So with this, again, we're in the very early stages of a bull market. Fundamentally speaking, we believe that this will continue given earnings, given monetary policy and so on, which I talked earlier about. So if you have that mid to long-term time horizon, then you probably don't need to have significant changes. That being said, if for whatever reason your financial situation has changed, you have different cash needs or what have you, then we need to actually address what's happening in your financial situation in the portfolio and make adjustments as needed. Now, that is a conversation we would have, conflict or no conflict, okay? Because that's something that we need to address on a regular basis to reflect what's going on in an individual's life, okay? So with that, that's my last kind of piece. I just wrapped up. I have no other questions here that I see. If you do have questions, guys, please feel free to reach out. Feel free to reach out by email. You can give us a call at the office. We're always happy to listen, lend an ear of what our thoughts are. We're having meetings internally on a regular basis. We have a full team here that are very attentive. That we're generally all within reason, pretty easy to reach. So again, if anything comes up, like I said, don't hesitate to reach out. We have had a handful of calls, not a ton of them so far. I think part of that is because we do these sessions on a regular basis. And by the way, we will continue to do them on a monthly basis. This is one of the things I wanted to mention. The feedback that we received, for those of you that were curious. So one of my concerns, and I'm full transparency, I was concerned about the cadence of what we were doing in terms of these sessions on a monthly basis, in terms of my commentaries I've been sending on a weekly basis. In large part, I think 90% of the individuals that responded, and we had a lot of response, we actually were told to expect maybe to have 20% of you that responded. We probably had in the neighborhood of 60 to 70% of you responded. It was incredible. The general feedback, over 90% said, we like the cadence as it is right now. We'd like to see it continue. So with that feedback, we will continue to do that. A couple of other key points, the type, whether it was email, whether it was video sessions like this, the majority of you liked both the webinar sessions and the emails. Those were the top two. The third one was potentially a podcast or in-person sessions. So we will continue to do the monthly sessions and the weekly commentaries. The other one that you gave really great feedback on was the content. So what type of information would you like us to share with you? So I actually thought tax would be probably one of the top things. Surprisingly, tax was number 3. Number 4 was the legacy and the state. And by the way, all of these were very close. So it wasn't like one stood out significantly, but the top two were were markets and economic updates. Those were the two that we received feedback that were the top topics of requests. So again, we'll keep doing what we're doing today. If anything ever pops up where you say, hey, can we unpack a specific topic? Always happy to do any of those on these subjects, even if we bring on a guest speaker or what have you. But like I said, the feedback that you provided was top notch. Humbly, like I said, I appreciate you taking that 5 minutes of your time to share with us. And I'm pleased that we're on the right track and what we're providing is helpful, especially during these types of periods. So again, doors always open, guys. Please don't hesitate to reach out. With that, I'm gonna bid you adieu and let you, as I look out the window, bid you adieu to the wet day today. Hopefully it improves. And like I said, I hope everybody has a great week, and we'll catch you in the next few weeks for the next session. Everybody have a great day. Thank you so much for joining us.